Digging into the data, the numbers are not what they seem. We're going to discuss what looks like a very strong housing market, but is a trend just a lot of hot air? Recent data also suggests manufacturing is back on track, but is the industry actually teetering on the edge? The existing home sales figure reflects a transaction volume. In other words, the number of sales of homes already built. This month, that figure rose to 4.38 million, which represents an 11-month high. Of course, we should not look at this data within a vacuum. Under what condition is the volume of sales increasing? In this case, it looks like prices are also rising. The median sales price of existing home has now risen to over 384,000, a 3-month high. The inventory indicates the number of properties that are active on the market. That number has now increased to a little over 1 million, also a 3-month high. This rising figure may lead us to believe the market is now flush with inventory. While the raw number of homes in the market is rising compared to demand, it's actually not enough. The month supply shows us, given the current pace of sales, how many months it would take to sell all the homes currently on the market. A high number, such as 9, occurs when there's excess inventory. A low number, around 3, indicates a seller's market, where buyers have very little choice. The month supply currently sits at 2.9, a very tight market indeed. So where does this leave us? Transaction volumes are rising. Transaction prices are rising. Demand is surging. Inventory is shrinking. And all this is happening in a high interest rate environment. This begs the question, where is the demand for homes coming from? This inflationary trend has been kind to the real estate prices, but it certainly has not been the best investment. This is from investing.com. In 2023, the Dow Jones Real Estate Index was up 7%, but gold was up 13%. Small cap stocks almost 14%, and US large cap stocks over 24%. So why is there such a demand for real estate? Well, the truth is, there are many reasons. We're all motivated by our own situation. We want to keep pace with inflation. Given the purchase of a home represents the largest financial transaction for most of us, a homeowner is able to keep pace with inflation. This is related. We fear missing out. It's not a good feeling to watch home prices continue to rise and we don't have the ability to participate in the growth. While investments really don't go up in a straight line, most people still think of the markets as linear. There's also a strong belief that if there's so much demand for homes with high interest rates, how much more demand will emerge as interest rates start to decline. We recently spoke about the surge of rental prices. Purchasing a home can create the opportunity for an income producing investment. In fact, in the most recent Consumer Price Index report, we made note of those sectors that are experiencing the fastest pace of inflation, of which includes rental prices, surging 6% on a year-over-year basis. Of course, we cannot remove the fear of missing out. That's just human nature and part of the market psychology. But let's consider if this strength in housing was occurring alongside rising salaries and a healthy supply of homes, that would be true organic growth. But that's not what we're seeing here. Home prices are rising with a tiny supply, less than 3 months of inventory. In other words, prices are rising, but that does not necessarily imply a strong economic foundation. We now pivot to the Philly Fed Manufacturing Index, which lately has been a source of great misery. But that may now be changing. At a current level of 3.2, while this is certainly not breaking any records, it does represent the second consecutive month in positive territory, following 5 straight months of decline. Inventories also rose back into the positive at a level of 4.4 following 5 consecutive months of negative readings. This shows us the manufacturers are beginning to increase their stock levels, perhaps in anticipation of increased demand. Amazingly enough, unfilled orders have now crossed into the positive region for the first time since May of 22. Increases in unfilled orders can represent an increase in demand for products that manufacturers have yet to produce. We see progress in current shipments and new orders. It appears as though the state of manufacturing in the Philadelphia region is starting to turn the corner. But wait, before we get ahead of ourselves, this may not necessarily be the case. This progress may only be skin deep. Let's dig a little bit below the surface. Consider the Philly Fed prices received. This shows us the prices manufacturers are receiving for goods produced. This has been on a steady decline now since January of 23, now registering only 4.6. The progress we're seeing in the Philly Fed numbers, such as inventories and unfilled orders, may simply be the result of more volume because manufacturers have been forced to cut prices. If we saw this progress with increased prices, well, that would be progress. Let's consider the prices manufacturers are now paying for raw materials used in production. Here we see a massive drop as well, from over 24 to a current 3.7. So the manufacturers are receiving less for their goods, but also paying less on the wholesale level, amounting to probably a negligible difference in their profit margins. In fact, we can see over the past 2 years, both prices paid and prices received have been trending lower. Maybe this is just the result of easing in the inflationary pressures. On closer examination, prices received seems to be leading the way lower. In other words, manufacturers are receiving less orders, which in turn leads to less production, a reduced need for raw materials, which forces those wholesalers to also cut their costs. In short, lack of consumer demand is dragging the rest of the industry lower. To truly understand the complexities of the economy, we must now consider the data from every possible angle. Housing may look strong, but we should consider, is this the result of a strength and a true widespread demand, or moderate demand and very tight supply? The manufacturing sector is showing some signs of growth, but not if the increase in volume occurs at the expense of lower prices. Just two examples of how the data takes on different tones, adding in a little bit of context. We hope you'll continue to join us as we dig below the surface in our goal of seeing the economy for what it truly is.